Okay, good morning to everybody, those who have joined late. We have finished one module, completed one module last week. That's about the role of compliance. And now, today we are going to start the corporate governance and compliance, basically the importance of compliance and the connectivity between the corporate governance and compliance. So it's a very important and vast area. So I'll be talking and discussing many areas which probably you may not find in your handout. So on that note, I would strongly recommend take notes because it's a vast, very large area. It's not easy to capture everything into the handout. So there will be lots of discussion and you all can make your own notes that can be material for questions also, right? So the crux is here in the note, but the facts we are going to discuss, the material facts, and will need to be encapsulated into your answers when you are answering. So therefore, make your own notes, right? Right. Now, what do you mean by corporate governance? What do you mean by corporate governance or the objectives of the corporate governance? Right? The corporate governance, it's all about governing your business properly. In simple terms, if you say it in Sinhala, yapalane, mostly, misused word, right? In the past, right? So, but the true meaning of yapalane is good governance. So the corporate governance is very much linked to good governance. How do you govern your organization? How do you manage your corporate in a better way, in the best way? That's good governance, right? So corporate governance is that. So effective corporate governance practices are essential to maintain public trust and confidence in the banking system, which we discussed in our first module also. The public trust, the confidence the public keep or have on the organization is extremely important for the continuing nature of the organization. Because if you lose the public confidence, the trust of the public, the trust of your customers, then, it's going to be a major problem right on the spot. Because we discuss, especially the industry of banking and finance, we are depending heavily in order to make our investments grant loans, advances, all that we are using the public funds or your customer deposits. So the customer confidence or the public confidence is extremely important. So therefore, effective corporate governance practices are essential. It's a requirement. Without that, you can't do to achieve and maintain public trust and confidence in the banking system, which are critical for proper functioning of the financial sector and economy as a whole, right? So those are very critical things. Means if you fail to meet any one of those, the repercussions can be extremely serious. That's why you say critical, right? So if you don't have corporate governance, good governance within your organization, especially our focus is mainly on the banking and the finance sector, it will be critical if you don't maintain, because you will end up with so many negative sentiments. So therefore, it's critical for proper functioning of the financial sector and the economy as a whole, because the key players in the economy are banks and the financial institutions, so an important segment in the economy. So corporate governance is important to maintain those entities in a better way or the best way. And if that fails, the banks will fail, If the banks fail, that can affect the economy as well. So the poor corporate governance can contribute to bank failures, which could lead to significant public cost and consequences due to potential impact on applicable deposit insurance schemes and also trigger broader macroeconomic implications such as contagion risk and the impact on the payment term. Right. So some of these things we have discussed, I think you all are aware. Right. So if the corporate governance is not maintained or corporate governance is maintained in a very poor status, right, that will facilitate or rather lead towards the bank failures, right? So if the banks fail, in turn, it will create heavy public costs and various other serious repercussions and the consequences. Why? There is contagion thing called the contagion effect in the industry of banking. We discussed this, right? Can somebody tell me what you mean by the contagion effect? We discussed this. Yes? Contagion effect? Can somebody give it a try?
So it is effect of one incident spread it out to other areas. Say one bank failure can affect to
Yes.
failures of other bank. It is something like spreading one
Yeah.
scenario.
So
So
that is the outcome. You are right. That is the, yeah, you are right. That is the outcome. Contagion effect is you are very much connected. So due to the contagion effect only, when something happens in one bank, that affects the another bank or the industry as a whole. So the contagion effect is the banks and the financial industries are very much connected and knitted together by way of advances, by way of deposits, by way of investments, and by way of various other, maybe the long-term financial transactions, having debentures in one bank, having debentures in another bank, so like that. So they are very much connected. So as a result, the contagion effect is high. They are connected, contagion. The word stemming from the word connect. So they are so much together or connected. When one bank fails, that can affect another bank. As a result, it can affect the whole industry or then finally the economy and even the entire world economy. Then we saw the financial crisis that happened due to the so-called high contagion effect among the financial sector. Right. So due to this contagion risk or the contagion effect, right, it will create lots of negative consequences or impacts into the banking system and thereby to the entire economy as well, right? So we have the deposit insurance schemes in our country, and it's a common thing all over the world. You have the deposit insurance scheme where you are providing certain amount of protection to the depositors. But in Sri Lanka, of course, the sum involved is not very high. Still, if you take that bracket, majority of our deposit holders do have that. So if something happens to the bank, then the need arises to pay them through the deposit insurance scheme. That creates an impact on the economy because the public money has to be used to do that. So likewise, then that affects the payment system, right? So the entire world is, connected through the banking system. Payments are happening. You have the international, even out of your own jurisdiction, the transaction do take place through the banking system and the payment channels, right? So as a result, if one bank fails due to not having good corporate governance within that, then that can affect the whole world contagion effect and the fact that you have various payment methods and the systems and the channels and the payment gateways among the entire industry, and even going beyond your own jurisdiction. So the objective of corporate governance is due to stop this happening. So this was clearly seen in the financial crisis that began in mid-2007. Right? So the financial crisis began in 2007. Before that, I think we know that, I think you all would have heard about the famous the Enron case, right? Which happened in US. And, with that, this thing started taking place. And the financial crisis really triggered and shocked the world, the financial world, in the 2000 decade, right? So 2007, the main financial crisis took effect. So it is good for you to know how even get back to the history of corporate governance, how this corporate governance became an international phenomenon, and why that is being given. It is starting from the Enron case, which happened in United States. It was one of the largest, if I remember right, the 7th largest company. And due to corporate corruption and various accounting frauds, this company went bust. Then the shareholders lost about 74 billion US dollars. And the employees lost their jobs, including their pension benefits, which was significant, right? So as a result, then the issue started raising upon how to prevent corporate fraud and how to ensure accounting transparency, then how to ensure the protection of the investors. The need to look into these things in a more kind of in detail came up to the platform, right? Then the accounting systems followed by the industry, mainly the financial industry or the listed companies, I would say, were supposed to maintain GAAP principles, which is known as the generally accepted accounting principles. So they found that the violation of these GAAP, generally accepted accounting principles, led to this type of various frauds and corporate frauds taking place, including accounting fraud. Then the need came up as to how we could ensure that there's better governance within the organization, which was extremely important for the financial sector, banks, and the financial institutions. Today, it's not only the banks and the financial institutions, the corporate governance is extended, or it covers all listed companies. It's a question whether it should be stopped at that. Anyway, you can debate on it later. But for the moment, all banks, financial institutions, and the listed companies, where the public has invested their money in those companies, they are supposed to follow the corporate governance principles, right? In the Enron case, there were so many scandals on the off-balance sheet items or the arrangements. Then there were problems with the role of the mark-to-market concepts. And that was a company which dealt with various, derivatives, which some of the banks also, most of the banks also have. And they have manipulated those derivatives, like hedging funds. And, I think if I remember right, it was an energy company, and they were dealing with lots of energy derivatives in the market. So with that, this came up, and that was the US scenario. And similarly, this happened even in the other Europe, and the British, they were together at that moment, through the Cadbury Commission. Then the Cadbury Commission also realized that it is important to have good corporate governance in the financial sector, especially because the Cadbury report is well known as the financial aspect of corporate governance. So they have dealt on it, which paved the way for various, accounting disclosures, the various the profit, the profit ratios, then the efficiency ratios, the entire financial disclosure, including the corporate social responsibility. It is mainly focused on the accounting side, the Cadbury report. So this became part and parcel of the corporate governance. And after that, the Basel Committee, all this came up, and they came up with various codes for the institutions internationally to follow. And what we follow in Sri Lanka are also coming from the so-called concepts that came through the Cadbury Commission and the Basel recommendation and the Code of Corporate Governance in Sri Lanka, which has been established by the Institute of Chartered Accountants in collaboration with the SEC, Security Exchange Commission. I think I have given an assignment for one group to look into the SEC and the CSC regulations, which is important to do a comparison, right? You can go back to your drawing boards and look at this. That is why this type of assignments are also given, because you need to understand what regulations that govern the industry of banking. Because one thing, we are a listed company, we are a financial institution. We are talking about the banking sector, right? So the listing arrangements are discussed in the Security Exchange Commission regulations. And I would say most of them are generally focusing more on the financial matters and disclosure, right? So I just gave you a background of as to what the importance and the emergence of this corporate governance as an important area for every banker to know and every banker to practice and every banker to follow. Otherwise, it can lead to situations where the customer confidence or the public trust on your organization is hampered, shattered, and compromised. So coming back to the TUD, this was clearly seen in the financial crisis that began in mid-2007. The poor corporate governance could lead to market to lose confidence in the ability of a bank to properly manage its assets and the liabilities, inclusive of deposits, which could in turn trigger a bank run or a liquidity crisis. In addition to the responsibility between the shareholders, banks have a responsibility to their depositors and the stakeholders. So both these bullets, what they say is, poor corporate governance or absence of corporate governance can lead to loss of confidence in the market about that company. As a result, you will have liquidity issues because the investors or the public or the world needs to be given an assurance that the monies that they had deposited with you or the investment they have made with you are in your safe hands, and that we are managing it, handling it on a trust basis, on the understanding that it will be paid with a return to them on demand or on an acceptable maturity period or after the completion of the contracted period or whatever it is you may call it. We need to give their capital back along with a return. So that confidence needs to be created in the minds of those investors or the customers or whoever who deal with you. So therefore, corporate governance is so much important. Now we'll see the definition of corporate governance. There are various definitions given, but I found the best definition among many definitions that have been given for corporate governance has been produced by the OECD. So OECD principles of the CG, the corporate governance, defines CG as involved in the set of relationships between the company management, its board, shareholders, and the other stakeholders. Try to understand this. It says corporate governance is nothing but the various relationships among the stakeholders of the company. That's corporate governance as per the OECD direction, if you put it in a layman term. What does it mean? It talks about a set of relationships among the stakeholders. Right. Now, for you all to understand this, how many are logged in by now? Can somebody tell me?
45, sir.
Okay, so good number. Right. So I need some interactions now. What do you mean by a relationship? Or what are the essential things for a relationship? You talk about a relationship. There is a certain prerequisite that you need to have before you talk about a relationship. What is that?
Communication.
Okay, communication, right. Okay, for you to have a relationship, you need to have two or more parties. You know, there can't be relationship, it's only with you, no? When you talk about a relationship, there has to be minimum two parties to it. Then only you can talk about a relationship. Agree? Agreed or not?
Agreed, sir.
Agreed, right. So, just take a simple relationship. Take your family. Right?
Hello, sir.
Yeah.
Can I disturb?
Yeah, please go ahead.
Yeah. So now the relationship, it is now something like responsibilities of the board and the management. For example, say board should represent the professionals, expertise from various sectors, and then that depends on the better relationship with the corporate management. Is it correct or is it relevant? Say, for example,
No,
that
you are correct. You are correct. You are correct. Okay, your answer is right, but it needs to be enriched with so many other factors also.
Yeah. Yes.
But I'm trying to explain this. The OECD
Okay.
definition says it is a set of relationships. Right, Mano? Now, the question I asked was, in a relationship, you need to have two parties, minimum. Right. When you have two parties in a relationship, just take your family as an example. Just give me an example for a relationship within the family. Two parties. In the family, just a very small, simple example. Who are the two parties in the family? Just name. You have father, mother, husband, wife, son, daughter, sister, brother. You have so many. Different relationships are there. You take the relationship between the husband and wife. That's a relationship. Agree? Yes or no? Hello?
Yes.
Please answer because I'm trying to get the audience involved. There is a relationship, husband and wife. So for this relationship to be maintained strongly, right, there are certain things that you should do and certain things that you should not do. Right? So if the relationship is there, obviously, any relationship you just think and dissect, you will understand there are obligations as well as rights. Just take the example of father, son, or the father and the children, or the parents and the children, or husband, wife, whatever it is, any relationship. If there's a relationship, you will always see that there are obligations on the part of those who are having the relationship. Say the parents, children, there are obligations on the part of the parent for the upbringing of the children. Provide them shelter, food, clothing, protection, love. That's their obligation. Correct? When you have an obligation like that, you have a certain amount of rights also. In an ordinary, any relationship, you have obligations and rights. Correct? So the parents have an obligation to bring up their children by providing them food, shelter, the caring. So that's an obligation on the part of them. They have a right also. What is the right they have? Right? In our society, parents can even, advise. You can't go and advise an outsider like that. You can tell them what to do, what not to do. Give them the guidance. Take them in the path that you think is best for them. Punish them if you do a wrong thing. That's a right, because you have an obligation. So similarly, what is the obligation on the part of the children? What is the obligation on the part of the children towards the parents? Huh? What is the obligation on the part of the children towards the parents?
To look after.
Obedience.
Yes, obedience. You have to obey the instructions or the advice given by the parents. You have to respect them, right? You need to do justice to their efforts by carrying on their educational activities, behave properly, right? So that's an obligation on the part of the child or the children towards the parents. They don't have an obligation to obey instruction given by somebody else, no? Correct? Likewise, they have a right. They have a right to seek protection under their parents until they are minors, reach the age of majority. They have the right to get protected by them. They have the right to get food from them. They have the right to get shelter from them. Right? Likewise, the example I took is any relationship you take, you will see that there are obligations and rights. The obligations of one party generally invariably become the right of the other party, and the right of the other party becomes an obligation of the other party. So that's how these relationships work. So what the OECD says is, the corporate governance is defined as involved in set of relationship between the company management, the board stakeholders, basically, I would say among the stakeholders, corporate governance. So who are the stakeholders in a company or a bank, listed company? Who are the stakeholders?
Shareholders,
Shareholders, yes.
employees,
Sorry?
employees,
Employees, yes, yes, yeah. Who else? You have directors, you have managers, right? The corporate management, the KMPs, right? Then you have your investors, you have your customers, then you probably have your regulators, and you have the law enforcement agencies, then you have the general public because it's a listed company. Like you have so many stakeholders. Even the general public is a stakeholder of your company, though they may not be a customer. The stakeholder means it has a vast, very large scope. It encapsulates almost everybody who can be affected by an action or an omission or a commission of your organization, right? So they are all stakeholders. So as per the OECD, it says it is a set of relationship between the company's various stakeholders. So now we put the basic that we learned now. In a relationship, you have obligations and rights. The obligation of one party invariably become the right of the other party, who is on the other side of the relationship. It's vice versa, right? So therefore, as per the OECD, that's where I took this OECD definition. It gives lots of meaning. So when it is a set of relationship, you take the board, the directors, and the company or the management. Now there's a relationship. So there's a responsibility or obligation on the part of the directors towards the company, right? So it becomes the right of the company to get directed by them. That's why they are called directors, who sets the policy, who sets the tone from the top. Similarly, the company has something to offer them in turn, to follow the policies given by them. Bring the procedures in order to meet the policy requirements approved by the board. So that's an obligation on the part of the management. Support them by following their policies and providing them various reviews and the reports. So this is governance. You take a customer and the bank. The bank-customer relationship also takes different forms depending on the type of the activity that you do. If you go to the banking law, the bank-customer relationship takes different forms depending on the transaction or the type of the activity that you are engaged in. What is the normal relationship between the bank and the customer, the primary relationship between the bank and the customer? What is the primary relationship? Banker-customer? Those who have learned banking? What is the primary relationship between the banker and the customer? Yeah? What is the primary relationship? There are various relationships. That is the primary relationship.
Fiduciary.
Huh?
Hello, sir. Principal agent. Principal agent.
Principal agent is right, but that's not the primary
Data-creditor relationship.
Sorry?
Data-creditor relationship.
Data-creditor. That is the primary relation. The moment the customer comes and opens an account with you, the relationship commences, the contract begins, and the banker-customer relationship starts. So it's a debtor-creditor relationship. Who is the debtor and who is the creditor? Who is the debtor and who is the creditor?
Bank is the debtor.
Hmm?
Then is the credit.
Yeah? Talk loud. Who is the debtor and who is the creditor?
Customer is the creditor, bank is the debtor.
I don't hear you. It's okay. I mean, give it a try. We are in a learning room.
Customer is a
Customer is the creditor.
Customer is the
Creditor.
creditor. Right, you are right. Because he is the creditor because he gives his money to us to be repaid on demand. So he gives his money, then the banker becomes the debtor, customer becomes the creditor. The relationship reverses. When the customer borrows from the bank, then it becomes the debtor creditor, where the customer becomes the debtor and the banker becomes the creditor. So starting with the primary relationship debtor creditor, banker is the debtor, customer is the creditor. Then when the customer borrows from you, right, he becomes the debtor, debtor, and the bank becomes the creditor. So as somebody mentioned, I think Mano, principal agent. So I told you this relationship changes. I'm trying to connect this, right? So principal agent relationship. When you are supporting him to open a LC to facilitate a foreign transaction, right? Then the customer is the principal, you become the agent because you are dealing on behalf of him. Bailor Bailey, as when it comes to the question of safety deposit lockers, pawn pawnee, mortgage or mortgagee, right? Then the custodian and the principal. So you have various relationships within this organization, depending on the type of the transaction activity that you carry out. So every relationship has an obligation. If you go to the customer charter, it talks a hell of a lot of, more than 75% of that tells the obligation on the part of the bank towards the customer. And it deals latter part, the obligation the customer has towards the bank. So any relation there are debtors, the obligations and the rights and the obligation to exceed. So OECD says set of relationship. So in order to maintain good governance, those relationships need to be maintained properly. When the relationships are maintained properly, there are obligations on certain parties, there are rights on certain parties, on every party basically, right? So if these relationships are properly maintained by, honoring your obligations and exercising your rights properly without exceeding your limits, obviously there's good governance, right? So as per the OECD, it says the good governance involves in set of relationship between the company management is board. So you can do as a homework for yourself. Think about it. You take any relationship and put this into this definition and think about what you learned and understand, okay, even the manager and the subordinate, there's a relationship. So you have to fulfill certain tasks. That's your obligation. Once it is done, then you need to treat them properly, provide them guidance, give them their due recognition. So that's a relationship. All this is part of good governance, right? So we are talking about the corporate governance, and the OECD says it is a set of relationships. Are you all clear on this now? Now I explain to you how the good governance evolved. Why this became so important. If we do not follow this, what are the consequences? Then we touch on the OECD definition of the corporate governance and try to apply it in our day-to-day functions to understand what it says. Because this understanding is very important. Otherwise, this whole thing which I said can be said in 5 minutes. The OECD definition says it is involved with a set of relationship between the company management, its board, and the stakeholders. So you will take it from this year and put it out from the other year. And you will learn this by heart and then come and probably answer the question also. The purpose is not properly served. That's why I'm taking time for you to make you to understand what is meant by corporate governance, right? It doesn't stop between the bank, the board and the management. No, it applies the good governance, the corporate governance, though it is mainly focused in Sri Lanka or maybe in the whole world on the financial aspect and the disclosure requirements. If you look at it from a very broad perspective, corporate governance should cover or bring together or encapsulate all verticals, including marketing, IT, HR. There has to be transparency in all what we do, right? So that's corporate governance. But in Sri Lanka, in most part of the world, main focus on corporate governance is within the boardroom functions and where the regulator is involved, and then it's mainly on the accounting and the disclosure requirements. But in real sense, corporate governance it covers more broader aspect if you are to get the right results the right way, right? So the CG also provides structure through which the objectives of the company are set, means of attaining such objectives and monitoring of the performance. So it provides a structure through the objectives of the company are. What are the objectives? How do you define your objectives? And the means of attaining such objectives becomes part and parcel of the corporate governance. So the good corporate governance should provide proper incentives for the board and the management to pursue objectives that are in the interest of the company and its shareholders. Presence of an effective CG system within an individual company or group and across an economy as a whole helps to provide confidence that is necessary for proper functioning of the market economy. So what it says, when there's good governance, that's exactly why I said the corporate governance should involve not only the financial reporting and the boardroom activities or the connected activity, it should involve even the HR function, right? So that if there's proper governance within the HR, you need to have your governance requirements as to how you would do your recruitment. Most banks have, as to how you would place them on various scales. Is it a performance based or the fixed salary scale? And how do you promote them? How do you review their performance? How you give the feedback? There has to be transparency, right? So the corporate governance says when you follow the good governance principles or the corporate governance, there has to be proper incentives offered or paid or made available to the parties concerned for delivering their job. So there has to be economic value for every transaction that we do. If you do your job properly, then your salary will be paid. If you do it better, probably there will be performance value, incentives. There will be bonuses and things like that. So this provision of incentives also is a part and parcel of it. Actually speaking, this probably came up because if you go to the financial crisis, the international financial crisis that triggered in latter part of the 20th century or the 2000s, it started from the subprime crisis. I mentioned this. And then one other important aspect in this was there were extravagant salaries and the compensation packages paid to the top management, right? They have been enjoying living a very luxurious life by drawing extravagant compensation packages, large compensation packages, which probably did not align properly with their due roles that they played. Then they basically made a very fast buck by showing large book profits and got the compensation back, saying that the companies are doing well. But then the sustainability became a problem there, because most of them were, the unrealistic growth in the loan book and the investments. They couldn't realize the actual profits. The loan book was grown far in excess of the realities. That's why you call it the subprime crisis. The properties that they took as security did not have the actual value on which the advances were granted. And there were debt securitization facilities were given one on top of the other. So as a result, finally it crashed. By showing unrealistic, expanded profits, which were not available, existing in real terms, the top management was drawing very high salaries and the compensation packages. Then only they brought in these concepts, bringing various concepts within the organization, like you need to have a HRRC. If you go into the practical aspect of this good governance, probably I have a feeling that you all would have covered it under different module through some other lecturer, right? The various subcommittees that regulatory subcommittees that you need to have, like the BIRMC, Board Audit Committee, and the HRRC, Human Resources and Remuneration Committee, then the Nomination Committee. Have you all covered this through some other section? Have you all covered it through any other section conducted by any other lecturer in this course? The structure, the responsibilities and all that? All your lectures are over? No, it's only my lectures are on, right? Other two lecturers have finished their part. Hello, am I being heard or nobody speaks?
Hello. Hello.
Yeah. Yes.
Only you are now. Other two lectures, they have done their lectures. Only thing that these areas, if I'm not mistaken, not that much covered. They have brief, but not that much. Not a lengthy coverage there. I don't know with the others agree, but if I remember.
Okay, I will touch on it then, right? So if it is already done, no point me repeating, right? So that's what I say. Now, see, I'm still on maybe the third or the fourth slide, right? So lots of facts we are discussing. You better take notes, because this is important, because all these things cannot be brought into the note, right? So the principle says the good corporate governance should provide proper incentives to the board and the management to pursue objectives that are in the interest of the company and its shareholders. Truly speaking, this requirement came up because of the fact that there were very unrealistic large payments that they have been drawing, the top management, by showing unrealistic book profits in the organization, which finally led to the total bankruptcy of those, and then it was a total run on the banks. The financial crisis that we faced in latter part of 2000. That's one reason. So then the Basel Committee brought in this regulation. So there has to be proper incentives paid. When you say proper, it shouldn't be neither less nor too much. Due incentives need to be paid. So there has to be transparency in what we do. within the organization. If it is performance-based, yes, there are different HR practices. You have fixed salary scale. Then you have the performance-based salaries and then the other payment, whatever it is. So there has to be transparency in this. And no too much of payments to be made, which can affect the organization, right? That is why under the corporate governance, if you go into the practical side of it, there are governance requirements issued by the central bank based on this Basel Committee recommendation. And the bank needs to have 4 mandatory statutory subcommittees within the board, right? One is the BIRMC, Board Integrated Risk Management Committee. As we go on, I will discuss on this. Then the next one is the Board Audit Committee. This is statutory, you have to have, right? Then you have to have another committee called the HRRC, Human Resources and Remuneration Subcommittee, which will look after basically the salary scales and how the promotions are done, how the bonuses are allocated. All that will be supervised, closely supervised by the HRRC. So the board has a responsibility. Then you have another subcommittee called the Nominations Committee, which is the responsibility of that committee is to nominate people for the key position. For the board members, nomination of the board members to be recruited. Then the nomination of the key management personnel, right? The successors, the succession plan, all that comes under the nominations plan. In addition to that, you have the related party subcommittee, board subcommittee on the related party transaction. So that was subsequently introduced, not through the corporate governance direction, but through various other SEC directions, and then subsequently, I think the central bank also insisted the related party transactions, but mainly it's coming from the SEC, another regulator, right? So that there. Then in addition to that, you have various other optional board subcommittees, which are not regulatory compulsory, but most of the banks do have. Examples, you have the strategy committee, very important board subcommittee, but it's not a regulatory compelled to have. Then you have the credit committee, right? Most banks have the board credit committee. Then the procurement committee, the board procurement committee, based on the financial authority manual and the procurement policy of the company. Certain procurements need to be referred and approved by the board procurement committee before it gets to the board for its approval. So you have various subcommittees like that. If you are not covered, you can make notes of these things. In addition to the 4 regulatory compulsion is recorded to have 4 committees: BIRMC, Board Audit Committee, HRRC, and the Nominations Committee. So in addition to that, you have other committees like Strategy Committee, Credit Committee, then and also the RPT is regulatory. You need to have the RPT. So 5 committees. Other committees are not regulatory compulsory, but most banks do have them for various obvious reasons, right? So about the BIRMC and the Audit Committee, we will touch in detail when we go along with this, right? Then the presence of an effective CG system within an individual company or a group and across an economy as a whole helps to provide confidence that is necessary for proper functioning of the market economy, right? So we are in the market economy today. We call it the open economy or the market economy, which functions on the demand and supply theory, right? It's an open market. So if you are dealing in a market economy, in order to ensure functioning of the proper market economy, it's important that the effective corporate governance system within the companies that are part and parcel of this so-called market, which in turn forms the entire economy. Governance requirements are essential. Otherwise, that will affect the market economy and the economy as a whole. That's what it says. Right. From the bank's industry perspective, corporate governance involves the manner in which businesses and the affairs of the bank are governing. There's a typing error, please correct that. From the bank industry perspective, CG involves the manner in which business and affairs of the bank are governed, not governing. Please correct your the PowerPoint. Governed by its board and the senior management, including how they set the bank's strategy and the objectives, determine the bank's risk tolerance and the appetite, operate the bank's business on a day-to-day basis, protect the interest of the depositors, meet shareholder obligations, and take into account the interest of other recognized stakeholders, and align corporate activities and the behavior with the expectation that the bank will operate in a safe and sound manner with integrity and in compliance with applicable laws and regulations. What does this say now? From a bank's industry perspective, so looking from a perspective of a bank, corporate governance involves the manner in which how this business is operated. What is the business? The banking business. If it's a non-bank, the financial, the non-bank financial business. How this business is operated is basically the corporate governance in terms of, or rather inclusive of, setting the bank strategy and the objective. Right? So within this so-called corporate governance, good governance, proper management based, right? So it includes the setting of the bank strategy and the objectives. Part of it. How do you set your bank's objectives and the strategies? Right? So if you have your the objectives, know your objectives of your organization. How many of you know the objectives of the organization? Right? How many of you know the vision and the mission of your banks? How many of you know? This is important. Go back to your workstation and then probably try and understand what is the objective of our bank, or what is the mission of our bank? What is the vision of our bank? Right? You have, various bus corporate words, captured in this. But what is more important is to know what is meant by this. What do you mean by the mission? What do you mean by the vision? What do you mean by the objectives? What do you mean by the values of the organization? You need to very clearly understand and give meaning to these things if you want to make the real good out of these good concepts. Right? So setting the bank strategy and the objectives involves how the business is managed by the board and the senior management. So they need to know what is the strategy of this bank, where do we want to be, short term, medium term, and the long term. What are our business strategies? Right? Then they determine the bank's risk tolerance and appetite. In order to meet those strategic objectives or the growth objectives or the expansion or whatever it is you may call it, You need to know what is the risk we are going to take in doing this. Say it says you might have the strategic target of growing your loan book by 20% short term, right? By growing it by another, say, 30% or 50% in the medium term, to grow it by 60% or 70% in the long term, or expand your products, covering A, B, C, and D products. In short term, bring the digital banking platforms and do your operations on the digital banking platform. In the midterm strategy, you will have all that. In order to do that, then you need to have what is the bank's risk appetite and the risk tolerance, right? So every bank has a statement called the risk appetite statement. Have or need to have, which is approved by the board. So board needs to tell what is the risk we are having appetite in taking on this. Example, say in your loan book, there are different sectors to that you go and lend. What's our risk appetite in lending to the agri sector? Agriculture sector, there's a regulatory requirement to go and lend at least 10% of your loan book to the agri sector. That's a regulatory requirement. So if the bank thinks, okay, fine, you can't go play below that. You have to give 10%. If you don't do that, there will be a penalty for the shortfall. So these are, compliance requirements. You need to know, go to the drawing board and go to the basics. I think we understood, I think we discussed these things in the role of compliance. You have to have an idea of the overall banking operation. Not just the idea, some specialist idea. Certain expertise in all entire banking operation. Right? So then you talk these things, you understand it. Otherwise, you think it's total alien jargon coming up. So sector-wise, if a bank thinks fine, we are going to have a risk appetite of granting our loans going up to 15% of our loan book to the agri sector. That's the risk appetite of the bank. So bank is willing to take, because the agri sector lending is considered riskier. But depending on that bank's presence in certain area, depending on that the country's, the public policy or the government policy that the banks are supposed to encourage the agri sector, probably maybe that you are falling in line and agreeing to give 15% of your loan book to agri. So I'm just taking an example. So that's the risk appetite. You are willing to take 15%, grant 15% to agri sector, and you are willing to take that risk. That's the risk appetite. Right? Then if you are into various other products like, say, pawning, what is the risk appetite in granting what X amount of the market value of the gold as you advance? That's the risk appetite. So all these things need to be captured in the bank's risk appetite statement, and the business operations need to run keeping that in mind. Right? Compliance also need to know this. Right? As we go on, you will see how important the compliance to have. You go back to the basics again. You have to have your connections, the relationship with your peers, the internal auditor. I think we discussed it in our first module. Relationship, the compliance need to maintain with risk, with audit, with business operations, with strategy. You have to have your relationship, professional relationship, right? You need to work closely with them, right? The business. So the risk appetite will tell, okay, you are going to give your pawning advances, say X percentage, or you need to have a coverage of minimum 20% coverage on every advance that you give when benchmarking with the market value or the central bank gold value, whatever, that's just your call. You need to understand this business. You need to know when you are doing pawning, what is the benchmark rate you are taking? Is it the market rate or is it the central bank gold rate? Or is it the world gold price? Invariably, either it's the central bank rate or the market rate. Or some banks couple this together, whichever is higher or whichever is lower. Right? So the gold market is fluctuating, very vibrantly fluctuating. It goes up and all of a sudden it comes down. So you need to have your risk appetite very well set. This is governance. That's why I say in the corporate governance, so these things are important. So they determine the bank's risk tolerance and appetite. Operate the bank business on a day-to-day basis. How do you operate the bank in the day-to-day basis? Doing your routine transactions, starting from opening of accounts, taking deposits, lodging them, granting loans. You need to have the operational procedures well defined, documented, and put into practice. Protect the interest of the depositors. Meet shareholder obligations and take into account the interest of other recognized stakeholders. So protect the interest of the depositor, right? How do you look after the depositors? When you say to take interest of the depositor, it's not only the interest that you pay to the depositor. You have to, in whole, you need to look after the interest of the depositor. Otherwise, he will lose trust in you, confidence in you. Whether the depositors' monies are safe from moral hazard issues, from various internal frauds and things like that, then from, pilferage and things like that. Okay? So, having the required liquidity levels within your bank so that there are no problem in paying them back. So, then meet the shareholder obligation. So, there's an obligation. Now, corporate governance, obligations and the rights. Shareholder has an obligation to invest its money and wait until the dividend is paid. Right? So the bank has an obligation on the part of to the shareholder to increase the value of the shareholder. That's why these ratios are monitored. That's why they are published. Return on assets, return on investments, the cost of funds, right? So these are monitored in order to make sure that you give the due return to the depositor. Give the due return to the shareholder. Whether we are giving a decent return on his investment. Whether we are creating assets which can give a good return to the shareholder. Or are we just blindly creating assets which is not giving a return to the shareholder? All these things need to be looked at. Then align the corporate activities and behavior within expectation that the bank will operate in a safe and sound manner. So you need to align your corporate activities through your strategic plan, through your various other ways and means of implementing and putting your operations into practice. Right? So you finally do your business in a safe and sound manner. Right? So you have to always keep in your mind that it's a going concern. The sustainability is so important. It's not a thing that you can play a T20 game and finish it off and then, go home. No. The organization must run. Whatever the profit you are making needs to be sustainable profits. No point in having large spikes in your profitability. Right? You can make money like that. You can grant ad hoc TODs and various, very substandard credits. So immediately your profits will go up. But the question or the problem arises when it comes to the question of recovering them. How to keep the quality of your loan book, how to keep the quality of your portfolio, how to keep the diversity of your portfolio. All these things need to be looked at. When you talk about the risk appetite, you need to know where your funds come from. Is it by way of CASA or is it by way of FDs? Or is it by way of various other investments? What is the composition? How much of CASA you have? Right? So if the SRR is 4%, at least do we have 4%? Now, obviously, if the SRR is 4, the bank risk appetite would be to have something more than 4% in your current account. Right? Then similar amount, to do your funding. What is the savings base? The CASA, what is the percentage? Is it 40% or 50% or 60%, whatever it is? So that's the risk appetite. Right? So this is governance. When you say corporate governance, it encapsulates very broad picture into it. Though it seems on the face of it, it's all about the boardroom, it's all about the financial disclosures. No, it's not the case. But in real practice, yes, mostly our focus is more on that. But remember, it's not only that, it covers the entire thing, how the strategy is maintained. Right? So in a safe and sound manner with integrity and compliance with applicable laws and regulations. So in short, you are very, closely governed, highly regulated. So you do your business in compliance with the regulations. Whether you maintain compliance with the applicable laws, rules. When you talked about it, we saw you have the external and internal. External means the regulations, the laws. Internal means the internal requirement that you need to meet in order to fulfill the external regulations. We discussed all this. Right? When you're answering your questions, you need to bring these facts into your answer. Right? Then only you will, earn marks on those. Your answer is going to be rich and have content and weight. So the next one, move on. The idea behind the corporate governance is simple. Well-run companies producing better results. Right? So corporate governance, in other words to put it, we set a set of relationships, obligations, rights and all that. And you little by little, you are aligning it with your business lines. So the idea behind the corporate governance is very simple. That is a well-run bank or a well-run company which is producing results. Important. If you don't produce results, or if you don't have your bottom line, in order to have your bottom line, you need to have your top line. Right? So with the top line, you make sure that you have sufficient bottom line or profits, which in turn will increase the value of your shareholder. So you need to grow your business in a sustainable manner, keeping in line with the bank's strategic document approved by the board or endorsed by the board, and ensure the results are produced. Right? Otherwise, it will be a question like, you have everything, you do everything, and everything is 100% compliant, but there are no results. In Sinhala, we call it Leda Malat Bada Suddha. Right? Purpose is to treat the patient. In order to treat the patient, they gave some medicine. Bada Suddha, but Leda Malat. Right? So, compliance job is it's a very difficult job, that's what I said. You are the balancing element in between the regulatory requirements with that of the growth objectives. You need to look at both sides. Now the business line will look at the growth objectives. They may not have a very much serious concern about the regulatory aspect of it. They would somehow want to go again and get their targets in. Right? So their focus is there. If you look at the regulatory side, right, invariably what happens is they are very much interested in meeting the regulation. Right? That's where that Leda Malat Bada Suddha, I think, can come into play. Right? So, you do your business in a very compliant manner. So, account opening, say somebody comes, no identity card or, doesn't have the proof. You simply say, no, we are not entertained. So, you are compliant. But are you doing justice to the business? Are you doing justice to the business? Right? If that is not the case, then you are not doing your compliance function properly. Then there's no proper corporate governance within that organization. So that's why it says, right? So it emphasizes based on best practices managing formal external and internal relationships and well-run companies which produce results. That's why I say you need to establish the transparency of all what you do, focusing on the legal requirements, regulatory requirements, and the information plays a very key role in the business world today. Right? So you need to have your information, accurate information, proper information, timely information. This is also important when you talk about the corporate governance. Because without information, without data, you cannot make management decisions. Even if you make a management decision without having right information behind this, the decision can be crooked. The outcome can be futile. You may not derive the desired result. Therefore, having key information, accurate information, in a very organized manner is very important in doing business. So therefore, establishing transparency and emphasizing legal, timely and trustworthy information is also important part of good governance. The research suggests that those companies that have better corporate governance are more valued than others with less sophisticated systems. Right? Now today in the modern world, That is why they pay so much attention to this governance requirements. There are various evaluations to see who produces the best annual report, right? When you say the best annual report, it's not only that nicely printed book, right? It's all about the information given in your annual report, facilitating a better understanding of how your business is run by the stakeholders outside, the public, the customers, the shareholders, then maybe various other investors who are interested in making investments with you, right? So the information is important, and when you run your business in such a way that you make others to perceive and believe that there's good governance within this organization, and there's high level of corporate governance that's being practiced by this organization, that will help to increase the value of your organization. That will help to put your share value or the share price up. The rating agencies to rate you, which gives an indication to the investors and various other stakeholders as to the status of this company or the bank, right? So all these are very much connected. When you need to put everything together, now you understand, you will realize the importance of having high level of corporate governance, how important it is for a company or a bank to make their presence felt in the market as a sound and a sustainable bank. The studies also show that companies with good corporate governance are far less likely to be involved in survival and recovery planning. The researchers have proved that the companies which are well managed, sticking to the good governance principles, maintaining good corporate governance, are very less likely to be involved in survival, firefighting for survival. And to see to how you can bounce back, how you can recover. When you say recovery, it's not only the recovery of loans, it's about recovering your position from a bad state to a better state, right? So if your company is well run, if your bank is having a good level of corporate governance, the chances are very unlikely that you will face a situation of firefighting for survival. Therefore, it is important that the board and the senior management fully understand their governance responsibilities and have the opportunity to test their knowledge periodically, right? So in order to do this, it's important for the board and the senior management who are at the top of the pyramid, who basically, drive all other layers in the pyramid, sitting on top, the board and the corporate management, which are less in numbers in comparison to the rest of the community within the organization, who are in the bottom layers of the pyramid. To understand fully their responsibilities towards governance. What is my responsibility the board needs to think, what is my responsibility, the corporate management thing? In doing what? In governing this business in accordance with the governance principles. And they need to review this periodically. They need to test their knowledge periodically. Whether are we updated? Do we know what's happening around us? Or is it there are things happening below your nose that you don't notice? So they need to have that understanding about their governance responsibilities. And also the level of their knowledge on this area. The use of scenarios to discuss governance and regulatory challenges can be effective method of training. Right? So training is an important aspect under governance, even under compliance. We will discuss it in detail, little more detail, right? So you have to look at various scenarios. Probably you can take the famous or infamous Enron case. Where did they go wrong? When you compare ourselves with them, are we doing our basics right? Do we have our systems proper? Or are we still into certain wrongdoings that you found in the Enron case, which is a very example, very much taken in these studies and in the corporate world? So you need to have various scenarios to discuss and analyze and assess the status of your governance, to see whether you're on the right path, or are you in detours, or are you in slippery wickets. All these things you would understand by making a review and doing a self-evaluation now as to where you stand as far as these governance requirements are concerned, whether you are, in other words, to see whether you are having your corporate governance in place properly. Right. So, are you all clear up to this point? Right? Can I have feedback? That's important.
Yes,
what we discussed now, very important. It's important in terms of answering your question paper, and it's equally important in discharging your duties as a compliance officer or a compliance staff member, so that you understand this and going and then help you to do things more meaningfully when you get back to your workstations. So are you clear on this? We still discuss 7 slides, but then we discuss more facts. We discuss more areas which are not strictly captured into the PowerPoint. Are you all clear?
Yes, sir.
How about the others?
Yes, sir. Yes.
Right. So we'll move on. Monitoring corporate governance. Bank should maintain, right, sound control functions, including an effective compliance function which routinely monitors compliance with laws, corporate governance rules, regulations, codes, and the policies to which the bank is subject to, and ensures that deviations are reported to as appropriate. This monitoring should include meeting regulatory standards relating to corporate governance and the role of the members of board, senior management who are in the position of the significant influence. Right. So now we discuss the importance of compliance or the governance and how to comply with these governance regulations. What are the downside if these are not being duly complied with? All that we learn. Now we say the bank should maintain sound control functions, including effective of a compliance function which routinely monitors So you need to have a compliance function within your organization which routinely monitors whether you are complying with the laws and the corporate governance rules, regulations, the code, the policies, various ethical practices which the bank is required to follow or fulfill, and failing to do, or any deviation which can bring you so many and various negative outcome and results. If that is the case, compliance has a duty to bring it to the notice of the parties concerned by way of a report, by way of an highlight, with a clear mindset of putting it right. You have to make a report, fine. It's not only a reporter's job, but you need to, by reporting it, you are trying to avoid surprises, as I mentioned earlier, and by reporting it, you will facilitate the corrective action. And you need to monitor to see whether it's corrective action being done. That's another part of the responsibility. This monitoring should include meeting regulatory standards relating to corporate governance. So such monitoring you have, it should include meeting the regulatory standards relating to governance, right? So there are various governance requirements that you need to meet. Example, having those regulatory subcommittees. So it's a governance requirement, right? Then appointing various officers, directors to various committees. There are regulatory requirements. There's a composition that you need to maintain in these subcommittees. Who can head the committee? Whether an executive director can head it, whether it's an independent director who should head the committee. So there are various regulatory requirements. Are these areas being discussed with you all under other subject areas? Not done? Have you done or not?
Not in detail, sir.
I think better for you to know that. I don't know how it was missed. Anyway, just remind me. I will touch on it if it's not coming directly under my area. But it's important for you to know whether you get it for exams or not is a different matter. But these are not difficult areas. If you take your governance, corporate governance direction, you will understand it. Right? Okay, so I suggest you to take the corporate governance direction and read and come. So then you will get an understanding. It's very easy to understand the requirement, right? But better know. So if you have any issues, we can discuss depending on the availability of time. So the role of the board, the senior management. Some of these things we have discussed. The role of the board is to set the policy, set the tone from the top. They are the owners, or rather they are the authority that approves the policy. Right? Every policy needs to have the approval of the board of directors. So the policies are made by looking at the regulation. Correct? Now, there are various regulations issued. There are various laws passed by the Parliament, which are spelling out the requirement for the bank to have which policy. You take AML, there are 3 Parliamentary Acts. Prevention of Money Laundering Act, Convention on Suppression of Financing of Terrorism Act, then Financial Transaction Reporting Act. In addition to that, you have the FATF. These regulations do come from FATF, right? I'm sure you would have learned these things, right? Then you have minimum rules issued or published by the FIU, right? So those are the regulations. So you need to see whether the bank is meeting these regulations, which are captured in the policies, right? So, in order to do that, you need to monitor the level of compliance with various rules and regulations, and also the requirements of the policies, whether they are being duly followed in relation to various codes, various policies, you know. You have to have, how do you do that in practical sense? How do you do this in practical sense? You can decide on your own. The textbook or the requirement or the Basel requirement may clearly spell out what you should do. It doesn't tell how you should do, how you are going to. That's your call. Based on the culture of the organization, based on the size of the organization, based on the complexity of the organization, right? You will have different ways and means of doing this, right? So, one way is you can bring them into your compliance program. Now we discuss under the role of compliance, the need to have a compliance program, right? So you can bring them into your compliance program to see whether these policies are duly being met, policy requirement, whether the laws and the regulations are duly being complied with, or you can even get hold of the risk department and work closely with them, because in the risk, there's an activity that they need to do. I wonder whether I mentioned this. RCS, risk control self-assessment, with the risk division would drive the functionality is very clearly stated in the name of that activity itself, risk control self-assessment. So this function is driven by the risk CRO or the CRO's department, and it will request each and every department or the business vertical or the process owner to go back to the drawing boards and make an assessment to see what are the regulatory requirements that you need to meet and what are the policy requirements that you need to meet. And get them to make a self-assessment as to what levels are we complying with, or our level of compliance on various requirements. Now, for example, if you take any department, say recoveries, then the recovery policies are there, right? So are we meeting the regulatory requirements in our, so they have to make a self-assessment. They will first take so this is a different exercise I am saying. They have to take various, controls that they have brought in. If a facility is turning non-performing, right? There's a requirement that you need to categorize them, right? Substandard, doubtful loss. So whether it's happening, that's a regular requirement. So when a facility turns, say, 30 days, 60 days, 90 days like that, so it will get into the different bucketing system. So is our system capable of doing this automatically? Or there manual intervention required to do this? Another example, you say anti-money laundering. The regulation says you have to risk profile your customers based on the risk that particular customer relationship can generate in terms of AML/CFT perspective to the organization. By tagging the customer or profiling the customer as high, medium, or low risk. That's a regular requirement. Whether we are doing this. So this risk control self-assessment will tell, that's one aspect of it. So who is the process owner? The compliance is the process owner. So compliance, they themselves will see whether we have our internal controls or the systems or the procedures or methodologies in assessing these customers in the required manner, and whether we are profiling them high, medium, low. Right? Or are there any shortcomings? Are there any problems in those? Then you are able to capture that. That's called the regular monitoring, periodic reviews. Right? So the bank should maintain sound control functions, including an effective compliance function, which routinely monitors. So the compliance need to routinely monitor the bank's compliance with various laws, rules, regulations, and all. You will get hold of the business, the frontliners or the process owner and the other supporting departments like risk, audit, and external, internal. You can get information from those and make this evaluation. So in monitoring the governance, the compliance has a very big, important role to play. That's what it emphasizes. Then this monitoring should include meeting regulatory standards relating to corporate governance and the role of the members of the board, senior management who are in positions of significant influence. Right? So in doing that, initially I discussed the operational level, but you graduate yourself to the higher level of monitoring. Operational level monitoring, then the higher level of monitoring. Probably whether to see the infrastructure is there or whether you are doing it at the policy level, right? So you need to understand the various roles to be carried out by the board, the senior management, and all that. Different roles, right? So with that, we will take a small break. And I'll try to give you, little understanding about, after the break, we will discuss what type of board, now that it has come to this, and the fact that you all tell me that you have not learned in detail about, different types of board. There are, the single tier board, 2-tier boards, like different types of board practices are there, or the concepts are there, right? So we will try and discuss the unitary board, the dual board, the different concepts like, having the board, then what are the job roles that are entrusted to these board members, the subcommittees, then the corporate management. So that we'll try to get a little bit of more insights into it after the break.
I am from the group 6, which we have been given the title as BCM, Business Continuity Management.
Yeah.
So in the contents which we have created, one of the content is role of compliance officer in BCM. So when we were discussing about that, we came to a collision that is that role of compliance officer is so related to BCM, or is that risk officer is related to the BCM? Is that compliance officer or risk officer who is more related to BCM? Can you please clarify it?
No, it's the risk officer. Now, if you talk about the business continuity management or BCP, it is a risk officer. He becomes one of the champions in it, in liaison with the IT and other business vertical health and the process owners. But the purpose of this exercise is to give you an insight into as to what the BCM is all about. Right? BCM is the bigger picture, BCP is falling within that, and then within that you have various other drills and things like that, right? So the exercise is to explore and understand what BCM is. Now this is for the compliance to get a flavor of what this game is all about. Because I told you my contention is compliance need to know, have expert knowledge on the entire business operation, including this type of new areas which are generally compliance. I find most of the people in compliance are lacking in this knowledge. So that's why that's given. So don't worry about who is the champion there. The finding is right. It is the risk officer who gets more involved than the compliance officer. So you don't have to confine it to the role of compliance into it. Compliance has a role, but it's not a very significant role. It will liaise with the risk and make sure. So you take it in the full picture and have a holistic view on the entire thing, and forget about the compliance involvement in that. Take it in independence, and then give your make your findings and submit your report on that. Okay.
Okay, sir. Okay, got it. Thank you, sir. Thank you.
You're welcome. Any other questions related to assignment, or maybe one or two or three people spoke to me during the last couple of days? Any others who have any questions? Right. So we'll move on. So please remember, we want now that 2,500 words is the minimum. Don't worry about the 4,500, right? You can go even up to, because some topics are very vast, right? You can write even thesis on certain topics. So don't worry about the maximum number. Minimum number, try to maintain, but at the same time, don't write 10,000, 15,000 words. I will not have time to go through also. So that's what I've given. So anything about 2,500 going up to 5,000, 6,000, 7,000. So don't go beyond 20,000. That means we'll have about 20, 25 pages, that document. Right. So have that, and we need a comprehensive approach, or rather findings on the subject given, so that it will help everybody to improve their knowledge on those subject areas which are important for the compliance to know. Right. So we'll move on. So I'll give you some insights into the different types of boards that we have. Now, there are two types of boards of directors, the two different types. You call it the unitary and the dual. Or in other words, you call the unitary board and the dual or the two-tier board. Two different types. So unitary board is one type of a board structure where typically you find in the countries like UK and US, whereas the other type of the dual board, which is common, the two-tier board are common in the Europe and very notably in Germany, right? So the characteristic of the unitary board is there's one single board which includes executive directors as well as non-executive directors, unitary type of board. But in contrary, the dual or the two-tier board, which you generally find in Europe and notably in Germany, it has two boards. One is called the supervisory board and the other one is called the executive board of management, right? And now, the executive directors and non-executive directors, you know the difference, right? Executive directors are the directors who gets, whilst playing the role of a director, you do some executive function. Managing director, he is a member of the board as well as he is doing the executive function. Mostly the managing director, chief executive officer, right? There are certain banks where the CEO just says chief executive officer and he is not a member of the board. He is there on invitation, right? Then he is not a board member. There are certain directors who do routinely work doing the administrative and the executive, rather the executive function. They are called executive directors. Or in certain government sector, you call them the working director. They are executive directors. So chief executive officer, MD, CEO, managing director is an executive director. Whilst being a member of the board, he is doing the executive functions also, right? So in a unitary board, where like, in the countries like ours, the Sri Lanka, we have the unitary board. You have both these types of directors in the board. Most of them are non-executive directors. They are not involved in the executive function. They are only looking at the supervisory and the policy level, giving the direction and strategy and all that. So that's their role. Among them, some directors like the managing director, while sitting in the board, they are doing the executive function. Now, certain banks, the chief operating officer is also an executive director, member of the director. I know the DFCC bank, yes, the MD and the COO, the deputy CEO, they are all in the board as well as they are in this thing. Sampath Bank, managing director, and the CFO is also a director. Group financial controller plus a director. So they are doing the executive functions as well as doing this. Commercial bank, the CEO and the COO, they are also sitting in the board. So they are doing executive function. Other directors don't do executive function, they are non-executive. Right? Now you are trying to talk about the boards. I will talk about it and then come and talk about the different types of directors also. So the board system that we have here is a single tier or the unitary board. You have both this type of directors sitting there. But in the dual or the two-tier board, which generally you find in Europe, they have two boards. The main board, or you call the supervisory board, who is mainly doing the supervisory and the policy taking, policy making functions. They are all non-executive directors. They don't have both types of directors in there. But below that, or rather parallelly, they have another board called the Executive Board of Management, where the KMPs are, they are also set of directors but doing executive function. That's the difference between this unitary and the dual or the two-tier boards. Are you clear? So in a two-tier structure, a management board manages the company business and accountable to managing the function. Basically, in our country, like what the corporate management does. They are managing the business based on the board directions. The operational function is done by them, right? But the supervisory function is done by the supervisory board. In Sri Lanka or in this part of the world, we have this single system where the board sets the tone, sets the policy, sets the direction, and they monitor having a supervisory approach to the entire operation of the bank. The corporate management runs the execution of the board policy and the board strategy. In the executive AMP, in our countries, you have one or two sitting in the board as well, right? So that's the main difference in these two types of boards that we find. Better for you to know that. So in general, the board members in a unitary board and the supervisory board in a two-tier system are elected by the shareholder, right? In the two-tier system, the members are elected by the shareholder. Now, even in Sri Lanka, where you have a unitary board, right? The board of directors are appointed and elected by the shareholders. But in that two-tier system, employees also can appoint directors to that second level board, the executive board, right? In addition to the shareholders, the employees are also given an opportunity to appoint directors to the two-tier board where the executive functions are being done. Okay. So, the board structures have responsibility for ensuring the financial reporting and the control system are effectively functioning. So whether it's the unitary board or the dual control, the dual two-tier board, it is the responsibility of both tier 1 board, tier 2 board, or the unitary board and the dual board to ensure that the financial reporting and the control system are well maintained as per the regulations, which is the responsibility of them. So in addition to this, you have another board called the Sharia Board, where the Islamic banking is concerned, right? It's different from a company's board of directors, right? But the Sharia Board is the board that governs the Islamic banking function. So in the modern Islamic banking, the role of Sharia Board forms an integral part of the Islamic banking, right? And there's a topic given to another group to touch on the Islamic bank. I hope they will make concerted efforts, because this is also an area where the knowledge of the compliance and in general, other than the people doing the Islamic banking, are relatively low or less or poor. So it's better to know. So I would invite that group. I can't remember which group. One group was given the task of looking into the Islamic banking. So I think and hope that they will come up with their findings on that, so it will help the others. Then in a Sharia board, what happens is, now this is different from a company board of directors, but the fact that we are talking about the boards, I thought it's appropriate to talk about it. So they monitor the working of the Islamic banking. The supreme body who decides on the Islamic banking is the Sharia board. So that's the governing board basically, right? So this Sharia board function is somewhat different to when it's compared with the other two different types of board that we discussed, maybe the two-tier board or the unitary board and then the the other, the two-tier board concept, that we are talking about the overall, managing of the bank. But the Sharia board, their responsibility is confined to governing the Islamic banking function. Clear? Right. So the Sharia board is comprised with, certain scholars and the intellectuals who have, great knowledge on the Sharia law. And the opinions of such board is basically, it defines and decides as to how the Islamic banking function moves on, right? And whatever the opinions expressed by them are called in the Islamic banking as fatwa, right? So I think for the moment that's enough to just a kind of a briefing of the different types of boards that we have in the world. The Sharia function is not exactly the same. The Sharia board function is not exactly the same of that of the other two types of board, where the governing of the entire industries, the bank is done by the other two boards, governing and the executive function. Sharia board is slightly different in terms of its functionality. So the party or the group who handles the Islamic banking probably will give more insights into this Islamic banking function, right? And coming back to the areas where you said not enough details were given, the role of various parties, the board of directors, their role is to frame the policy. Now, when I say frame the policy, board is not going to write the policy, right? The policy will have to be in practice. It will be written by the business or the process owner. Now, if the risk policy needs to be formulated by the risk department. The compliance policy needs to be formulated by the compliance department. The strategy policy probably will be framed by the strategy department or the strategy officer. The AML policy will be done by the compliance. Credit policy will be done in liaison with the risk and the credit together, or the risk will have to be in the driving seat as far as the operation risk and those policies. So whatever it is, the policies are approved by the board. So it's a board responsibility to make sure that there are policies formulated and created to ensure that the bank's business is run in line with those policies, which would ensure the regulatory requirements are duly complied with. We discussed this now. So then the board responsibility is to set the tone from the top, approve the policies, right? In practical sense, the policy is written by somebody else, but it's the board responsibility to make sure the policy is in place. And they approve it, right? And they set the final directions on the strategical directions as to, where the bank. Now, there that again, in practice, probably the strategy officer presents the strategy. In consultation, the CEO and then the various other process vertical chiefs and the heads. But it becomes the board responsibility to ensure that the bank has a strategy, right? Then the approval of the strategy is definitely the board function. Then looking after whether those policy requirements are being duly complied with, the supervisory role is also lies with the board, right? So board is sitting on top. That's the responsibility of the board. Then the responsibility of the management is to ensure the policies approved by the board are duly being implemented. That is the responsibility of the management. Right? Now, in our this part of the world, right, the managing director or probably the CEO who is doing the executive functions plays a dual role by sitting in the board where the policy decisions are taken, policies are approved, and they have a dual role of implementing those policies also, because they are executive directors who belongs to the management as well as they belong to the board also. Right? The unitary board system, that is how it works. But in contrary, in Europe, you find this the two-tier board or the dual board system where you have the primary board or the supervisory board, which consists of directors who basically play the conventional role of the normal board of directors. And there you don't get executive directors sitting there. But parallelly, you have another board called the executive board where all the KMPs, including the CEO, COO, and various other probably the KMPs will sit as directors there who are executive directors under the two-tier system who would implement. But in our country or this part of the world, that is handled by the management, and there are one or two or maybe three officers who are sitting in both sides. So that's the responsibility. So doing that, implementing the policy, putting the procedures in order to meet the policy requirements, and working on the policies, doing the reviews, assessment, all that is done by the executive function or rather the management. Right? So under corporate governance, it's very important that they have established especially under the Cadbury report or the Cadbury Commission, right, which is used as one of those base documents for the modern corporate governance. The Cadbury Sami, in his report, insists on the importance of segregation of duty. That is why the chairman, those days we remember, even in the Sri Lankan bank, chairman, managing director, right? But as per the Cadbury report, they have insisted and to make sure that this segregation is made, chairman cannot play the role of an executive. So in today, you will not find this in any listed company or especially in the banking and the non-banking financial industry. Chairman does not play an executive role and he is the head of the board. Right? So the segregation of duty concept that came mainly through the Cadbury recommendations or through the Cadbury report where segregation of duties have been established. Right? So then there are the subcommittees I mentioned to you, the BIRMC, Board Integrated Risk Management Committee, who would support the main board. That's a board subcommittee, remember. Board subcommittee. So the board members are the members of that, including there are certain provisions where now in the risk committee, there are permanent invitees. Some banks, they bring them as members of the committee. Some banks, they make those executives as permanent invitees. So in the charter or the terms of reference, the TOR of that the board subcommittee, it is clearly stated who are members, who are permanent invitees. So there's a quorum in the TOR. Who should be present in order to have a meeting as officially constituted, right? So these are the things which you find in the corporate governance. So I would recommend you to take the corporate governance direction and read it, and then you will understand this better, right? I don't think I will have sufficient time given the area that's assigned to me to cover, coupled with the fact that our group presentations are also going to take a longer time because this time I'm going to have 10 members sitting in one group. So it's going to take a long time. On that note, I don't know whether I have time to go into detail, but I'm just giving you a briefing for you to understand. Take the governance regulation direction. Each one of you have access to it and go through, and then you will get a clear idea as to more in-depth understanding and idea of what I'm talking now. You will get a better idea. So just read it and come next time. And if you have a doubt, you can always ask me. I'm more than happy to clarify. Right. So the board risk committee you take, this is a subcommittee. All the subcommittees are meant to study it in detail. Now, the board meeting, you can't go through all these things. Why these subcommittees have been constituted through the governance requirement to pay more focus on those areas and study it in detail and then assist the main board to make the final decision making. So the board subcommittee, the risk committee needs to be headed by an independent director. It's a requirement. It cannot be headed by an executive director. It is so with the BAC, Board Audit Committee. Right? Independent, non-executive. So the directors also, you have directors, two types, you call it the independent director. Independent directors are the directors who are appointed by the stakeholders, not based on the share ownership that director has to the company. Now, in general, you say the directors are the owners, stakeholders. They have the shares. By virtue of having shares, they get themselves elected to the board because they have the voting right. Now, directors are appointed by the members, no? Members mean by the shareholders, right? So the controlling shareholders will have more power to appoint directors to look after their interests. Now, in the banking system, the central bank says, in the banking corporations, generally, no company or no group can have in excess of 10% of stakeholding in that bank. That is in order, this is again a governance principle to make sure that banks, most of which are systemically important institutions, are not handled by one single group or one single person, because then there can be conflict of interest. As a result, you might face various, negative consequences, mainly that can arise due to conflict of interest, right? So the governance requirements restrict the voting rights. Or basically, it says you cannot hold more than 10% of the stakeholding in a banking corporation, because of the simple reason that they don't want that to be handled by one particular group or one particular individual. But in contrary to that, these regulations were brought in subsequently. By that time, there were certain banks which were owned by certain individuals and certain group of companies. Ultimately, the beneficial owner, if you dissect, it either revolves around one person or a one business family. They have been having this stake. Before these regulations came into effect, then they were given opportunity, time to shred their stakeholding, to sell their stakeholding in the market and reduce it to 10%. But for very many good, valid, and then obvious reasons, some of them couldn't do that, or some of them didn't do that. Then what the central bank did was they restricted the voting right of that stakeholder. Though they have more than 10, they maybe 20%, 30%, 35%, right? Not ethical to mention names here. There are so many. If you go to the annual reports of this bank, you will see who holds how much of shares. What controlling shareholding they have in terms of the group, or when you dissect, you know who is the real beneficial owner behind this. They hold more than 10, but central bank has, in fairness, they have restricted their voting rights to 10%. So irrespective of how much of shares they have, they exercise only voting up to 10%. So they cannot have a controlling stake, or rather, they cannot influence the decision making of the company just because of the fact that they had more than 10% of share. Right? So I was talking about the different directors, how the directorship arises. So the stakeholders, based on their shareholding and the ability to bargain, get their members appointed to the board. So the board has the maximum, if I remember right, the maximum number of directors you can have is 13. Right? You cannot go have more than that. And out of that, you have to have, there's a composition. I think it's good for somebody to go through the direction and come back, latest version. You have to have a good mix of executive and non-executive directors. You have to have a good mix of independent and non-independent directors. Right? So the non-independent directors are the directors who are representing the stakeholding of the bank. They are non-independent. Because they have their independence is compromised because they have a stake. But in contrary, there are certain directors who are recruited without having substantial share ownership. They are brought into the business to add value, to make it more versatile, to bring different expertise into the board. Then on invitation, they come. The nomination committee does that. Can you remember we discussed about 4 committees: BIRMC, BAC, Board Audit Committee, HRRC, Human Resources and Remuneration Committee, and the Nominations Committee. So the Nominations Committee function is to bring value into the board. So they nominate, they look after look upon the people who can add value, who will bring different expertise into the board. And they nominate, so they are not necessarily, they represent a particular stakeholder, or not necessarily that they own any shares. Maybe they own a nominal share. But they have no controlling power in terms of shares. But they are brought in. So they are called independent directors. The directors who get appointed through the share ownership, they are non-independent directors. So that's the difference between independent and non-independent. Then you saw another categorization, executive, non-executive, right? So there are directors who carry out executive functions. They are called executive directors. The other directors who are not carrying out executive functions are called non-executive directors. So there can be, any director can be categorized as non-independent, non-executive. So that means neither they perform executive function, nor they own significant shares, and they are being brought into the company board because of probably due to the expertise they have. Right? So any director, you need to know, you take any director in the bank, you will know either whether he is an independent director or a non-independent director, executive director, non. So if that's why any director, you say independent, non-executive. Non-independent, non-executive, right? Non-independent, executive. So likewise, the directorship is categorized based on this. So now you understand who are the directors, what type of directors are there, what is meant by independent, non-independent, executive, non-executive, and what are the different types of boards we have, the governance. In this part, you have the Unitary Board, US and UK and this part, and Europe you have the two-tier or you call the dual board. So you have a fair idea of how this system works. And also I touched upon the Sharia board, which is not exactly the same, but it's called another board where the scholars and the knowledgeable and the religious leaders who are supposed to know the Islamic law, Islamic banking, the Sharia law, are governing the Sharia law, the Islamic banking function through the Sharia law. Right. So any doubts and queries up to this? Any doubts? Right.
Excuse me, sir.
Yeah. Yes. Go ahead.
There are two institutes which already issued code of best practice and corporate governance rules. Like CS Sri Lanka back in 2017, I do have a booklet, and as well as CBSL. So, what's the difference between those two set of rules
Yeah.
issued by
Yeah. Can you
two
identify
different
yourself?
institutes?
Okay. Can you identify yourself?
Sorry,
What's your name?
I'm Sanu Ratnagar. Yeah,
Nandun from
BOC.
which? Right. Yes, Nandun. I think good question. Now, when you say the regulator, there are multiple regulators. You take the banking industry, you are regulated by multiple regulators. Okay. Now, the main regulator in terms of the banking is the central bank. For banks, it is the Bank Supervision Department. You take the central bank as a whole, mainly the main regulatory part handled by the central bank, Bank Supervision Department as far as the banks are concerned. And the non-banks are concerned, it is the non-bank supervision department. But within central bank, those are the two main departments who get more involved in the regulation of the banking system. But there are other departments also that regulate. The entire central bank regulates, right? The payment and settlements are regulated by the Payment and Settlement Division, Director Payment and Settlement. Then the AML CFT part regulated by the FIU, which is also falling or functioning under the wings of central bank, right? Then you have the ISSP, the Information System Security Policies, again by the central bank, a different division. Then the economic research. So, you have various departments that regulate. So, central bank is one main regulator. Likewise, the question you asked, Sandul, there are other types of regulators also who regulate, the banking business. Now, the SEC you take, Security Exchange Commission, they regulate the listed companies. The listing rules are there. There are, I think, I remember right, those days, there are about 50 or 70 odd listing rules that a listed company or a public quoted company needs to fulfill in order to get the registration as a listed company. So the Security Exchange Commission is the regulator as per the, the listing requirement. SEC is regulating. Then the Colombo Stock Exchange also does a certain amount of regulation, which is going hand in hand with the SEC also. If you analyze, that's what I want you to, one group to analyze the SEC and the CSC regulations, because there are lots of similarities and there are little, additional requirements also coming. So that's why I want that group to study it and bring it to the notice of this for the other benefit of the other members on this group to get a fair idea. So that's another regulation. Then, in addition to that, I think you mentioned the Institute of Chartered Accountants. That's also a regulatory body in terms of financial reporting, right? Institute of Chartered Accountants in terms of financial reporting and presentation and the disclosure of the financial information. They are regulating that part. Okay. Now the code of governance, the code of conduct, governance code of conduct. That is also, if I remember right, has been pioneered by the Institute of Chartered Accountants in collaboration with the SEC, Stock Exchange Commission. So likewise, there are multiple regulators who govern, who regulates the industry of banking and the financial business, right? Now, the register of companies, that's another one. In order to register your company, there are certain regulatory requirements that you need to meet under the company law. So, the answer, the question you ask, who is the regulator? Both are regulators. They do multiple regulatory functions, but you need to obey all of them. The example, related party transactions, the central bank has related party regulations. SEC has related party regulations. The Colombo Stock Exchange has regulations. So these things vary from one another. If you are regulated by all three, definitely you need to meet the higher level of regulatory requirement. At least for that particular purpose, you need to maintain that. Have I answered your question, Sandhu?
Yes, sir. Thank you.
Right. So any other queries like that? Right. So we'll move on with our presentation. Which slide did we discuss last? Discuss. Do you see the screen? Do you all see the screen?
Yes, sir.
Yes, sir.
Right. Right. Slide 7 did we do? Studies also show that the companies with good corporate governance are okay. I think we discussed this. We'll move on to slide 8. Yeah. Monitoring corporate governance. The bank should maintain sound control functions, including an effective compliance function. I think we touched this also, which routinely monitors the compliance with laws and all that. I will discuss this. This monitoring should include meeting the regulatory standard relating to corporate governance and the role of the members of the board, senior management. Yeah, I think we discussed this. So, mechanism or some methodologies incorporated or put into practice, introduced in order to regularly monitor whether this, compliance with laws, corporate governance, rules, regulations, code of ethics and all are duly being met and complied with. Right? So that's the important compliance function. The compliance need to decide how they are going to do this. Now, there can be a question. Right? The question can be very simple and just, a couple of words. How do you ensure that as a compliance, how will you ensure that the corporate governance is duly being complied with by your bank? It's a very open-ended question. So you have to bring all these facts into it and summarize it and, present it in 30 minutes. You are given 35 minutes to answer the question. 5 minutes probably for reading and, doing the other, final touches and icing and all that. But 30 good minutes, good time is spent to give the answer. Within that, I would say 5 to 7 minutes you can take in formalizing your answer, what you are going to write. Otherwise, just you keep on writing without having a, skeleton on which you can add flesh and, to make a more comprehensive answer. You just start writing without knowing what you're going to write. And you write half a page, 2 pages, 1 page, then you still, you have not answered the question. That's wrong. You might, very likely that you will get very open-ended questions like that. then think about. So that's where you have to bring all the learning that you made into it. And this exam is to see how good you are in presenting or applying the knowledge that you gain in the practical scenario. That's what you are going to be tested on. So sometimes you might get a very straightforward question, that's fine. But it's not going to do much good to assess your knowledge. Right? If you get that question, how will you, as the compliance, ensure that the business of banking in your bank is run in a compliant manner? My God, I mean, you can write a book on this, right? Then you need to know how to answer the question. So that's the importance of taking the important points while this presentation is made, the decision is made. Then based on those points should come to your mind. Then you need to bring it and then collate with the question raised. And always try to, every point you write, try and link it to the question asked. And the examiner can't, refrain from giving you marks. As examiners, I can tell you, we always try to award marks. Sometimes you are put on a very miserable situation where you cannot award any marks, even if you want to, because the answer the students do not support that to provide marks, right? So this examination, in my personal view, is to see how good you are in putting what your learnings into practice when you get back to your workstations. Don't expect, very straightforward questions. If you get, you are lucky, right? Idea is not to give the straightforward questions, but to test you on your knowledge, to see how good you are in applying the knowledge that you have gathered from. But one pitfall that I have seen that most of the candidates fall in is, in an open question, they write all what the jargon, what they know in this compliance program. But they don't relate it to the question. They are not answering the question on the spot. Then probably the examiner is put in a very miserable situation where you know that he has written 5 pages on one question, but there's nothing concrete within the answer given to award marks. So when setting the question, examiner has in his mind, okay, I'm expecting these points for this to award marks, especially if it's a one single question where you are going to get 20 marks. It's you need to give all what you know and relate it to the question, right? So that's the importance of listening to these lectures and making your notes. And whilst making the note, you need to make your notes in such a way that you can always link it. Okay, this question, this information, it can be used for this, used for that in your practical scenario. Always remember, you are going to link your learnings to the practical scenario. Then it's easy to answer the question. Because majority of you come from compliance field and some of you are, of course, not from the compliance field, but they are all coming from the banking industry. So you got to have a prerequisite to have some knowledge of as to what's happening in the bank. So then it's easy. Right. So we'll move to the next slide. Maintaining independence. Now, under governance, effective management, maintaining independence. I think I touched on the segregation of duties. The concept of independence involves 4 related elements as shown below. The compliance function should have the format status within the bank, right? So in order to ensure that effective corporate governance is present in the bank, the concept of maintaining independence is very important. That's why the compliance officer is reporting direct to the board integrated risk management committee chair. Similarly, that's why the chief risk officer, CCO, chief compliance officer, CRO, chief risk officer, reports direct to the chair of the BIRMC, not to MDCU. We discussed this in detail when in our module 1. Then the chief internal auditor, CIA, he also reports, he or she reports direct to the board subcommittee chair of the BAC, Board Audit Committee, not to CEO. All this functional reporting is to the board, not with any other reason, but to give that the required independence to these functions and to the officers who do these functions to carry out their the operation or the business activity or the process activity in an independent manner without being biased. Right? So if that independence is not given, then probably, you may have to get approval to make a decision whether it is to be reported or not to report. Right? But at the same time, if you remember, when you discussed about the role of the compliance, we said nothing is done in the back of somebody. Because you are reporting it to the board, that's fine. You are given the authority, your reporting line, everything is there. But unless it's a fraud, I'm always saying, unless it's a fraud, you need to bring it to the notice of the parties concerned, not with any other reason, mainly with the requirement of putting that issue right, addressing the issue. You go and tell the board can't come and rectify it. So telling the board, if there's an issue, you need to bring it to the notice of that process owner or the vertical head or the business head, making him aware of the problem and giving him the way to rectify or remedy the situation. So when reporting it to the board, you need to make sure that the reporting is done with the recommendations also going hand in hand, rather rectification also going hand in hand with the issue, on the issue. Because finally, ultimatum is to have a problem-free operation, fully compliant operation. So that is the practical side how we are doing, but the independence is given for you to act independently. You don't have to get approval from your CEO, COO, somebody to deal with on a subject. Because that's why the compliance officer's job is a KMP role, a senior person who can sit on par with the other KMPs in the bank. That's why I always say the compliance officer job role is extremely difficult. You need to be an expert on everything. You may not have the expert knowledge that is equivalent to the expertise you have in managing that particular function in the bank. For example, treasury, your treasury head may have more expertise. That's no problem. But you also need to have some expert knowledge on the treasury management. You need to have an expert knowledge on credit. It may not be exceeding beyond the head of credit knowledge, but you have to have definitely knowledge, expert knowledge on the credit function. You have to have expert knowledge on the operations. If you don't know your operations, you can't play the compliance role effectively. At least you must have somebody under you who understands the game, through whom you can get the support. Now, in compliance, the compliance charter or your compliance policy always pave the way to seek expert advice. The compliance officer has the right to seek expert advice if he or she wants, because that role is so important. And in the TOR itself, it is mentioned in many banks. There is the international practice. Rather, giving that opportunity. Similarly, the board is also given the opportunity to seek expert advice if they want under governance. But at the same time, you can't be going and seeking expert advice for each and everything. Then it becomes, looking very funny, Everything that comes, you have to ask somebody. No, that is not what is envisaged there. You have to have that expertise, but anything where you need, you can even consult somebody. So there's provision in that, right? So we are talking about the independence of the compliance function. So that format status needs to be there within the bank for you to effectively function, right? So different banks have different structures because there are certain banks who have the group compliance officer, where the subsidiary units have different compliance officers and they report to the group, right? Now, there are certain banks where the group head of audit, the other subsidiary companies, audit function also comes under that same person. Because he looks after the entire group, the group compliance officer. Ultimately, the parent body, the parent board has the responsibility to make sure that the subsidiaries and the associates also carry out their business in a compliant manner. So you may have different, structures within your bank to have different compliance officers appointed to look after the different entities, and those compliance officers will report to the group compliance officer, right? Coordinating the management of the bank and the compliance risk. Okay, so you got it. Now, some banks don't have this group concept. They have the compliance officer for the bank and that's it. They have the compliance officer for the subsidiary and that's it. But under governance, remember, whether you have that internal structure or not, the parent company, if it's a bank, right? If you take HNB, you have subsidiaries, HNB Finance, HNB Assurance, right? Life and General, different associates are there. So whether there's that group structure or not, you need to make sure that the parent board need to make sure that your other subsidiaries also fall in line with the governance requirements, because if they don't do that, you are exposing your group to various risks like the loss of public trust and confidence. Because if you don't do your business in a compliant manner, there can be various repercussions and the negative sentiment that can arise due to being non-compliant, right? So maintaining independence is one important aspect. That's where the segregation comes in. The compliance function staff and particularly the head of compliance should not be placed in a position where there is a possible conflict of interest between their compliance responsibility and any other responsibility. That is why the compliance officer should not be doing business. If the compliance officer is playing a dual role of functioning as the head of operations, his job role is compromised. Then there will be conflict of interest. If the compliance officer is going to function as the head of credit, there's conflict of interest. So that's why the compliance function is made independent, have different independent reporting lines, in order to avoid this so-called conflict of interest where you may or rather push to a situation you are going to be biased on a certain decision. The compliance function staff should have access to the information and personnel necessary to carry out their responsibility. So you need to have, in order to have good governance and the best practices, The compliance staff need to have access to information. You can't be going and bargaining and rather begging to get information. So if you go through your, if it's a well articulated and formulated policy, it will say categorically in the policy itself that the compliance will have access to any information within the bank. If you are to have good. So then you have access to information, you can call for it and make your own assessment. But if you don't have that access to information, then maybe that you are, kept in a situation where certain things are hidden from you. That's not good. That's not correct. So you need to have access to the information, and also you need to have sufficient people, the enough resources, and the personnel necessary to carry out the responsibility. That's why the compliance is a costly function. You need to have people. But the pity part is they don't understand the importance of it, some of them. They think, why should we have this much of people in compliance? What returns are they bringing? That's your duty to make them aware. That what are the negative impacts? Otherwise what happens is if the compliance function is not duly, planted within your bank, the profits probably that you may generate can get eroded due to a certain non-compliant activity or action or an omission. For instance, okay, you make business, just open accounts without taking KYC, without maintaining profile, without doing due diligence, and you might still make big profits. But those profits probably may not be sustainable. The profitability can get eroded. You are granting loans in a haphazard manner. You are growing your balance sheet without concentrating on the quality credit. Your loan book will grow. So initially you will make your profits because you can make interest on provision basis. You will not realize. So the short term you can show profits, but it's not sustainable. If the credit granted is not quality, not of the due standard required, then it can turn a bad credit. And then the entire thing may be subject to get impaired. Then you need to keep provision for the impairment under general provision or the specific provision. Then your profitability gets eroded. You will have the top line, but your bottom line is affected because there's lots of provision going and hitting the P&L. Right? So you have to do business in a compliant manner. It's not only following the central bank regulation, not only following the SEC regulation, not only following the chartered accountants regulation, it's not only following the law of the land, it's a mix of following everything and doing business in such a way. That is why the compliance is not supposed to do business, because if they do business, then there will be conflict of interest. At the same time, as I have repeatedly been said, compliance need is in the middle. You have to support business by telling them how to do business in a compliant manner. Your role has to be complementary and supplementary to do business. If you are going to say no to everything, then you are not supporting the business growth. You are not supporting the frontliners. You are not supporting the process verticals. You are not supporting the business initiatives. You have to support it by telling them and guiding them and assisting them to do that business in a compliant manner. When a new product is developed and introduced, you need to be in that process right from the inception. Then you can advise them how to frame the product, how to develop the product. Otherwise, what happens is the product is developed without the compliance participation, without the risk involvement, without the audit involvement. They come up with the product, and then it's submitted for the product clearance through the product development committee, where the compliance is one party, risk is one party, internal audit is one party, in addition to the process owners and the product owners. So everything is done, material is also finalized for marketing and put the product out, and it's submitted for clearance. You will see fundamental errors in the structure of the product. You will see fundamental issues in the design of the product. Then it's a matter for you to asking them to get back to the drawing boards. It's a redone process thereafter. Then the business is grossly affected. Grossly affected. In order to avoid those, that's what I say, compliance and the other functionalities need to be there to avoid surprises. So if you are becoming and part and parcel of that development process where you are sitting and you are not doing business, remember, there's a very thin line here. Not doing business and playing an independent role does not mean that you are not going and supporting it. That's different call. I mean, you have to very clearly understand this. This is where most of the compliance go wrong. Because you also have a duty to grow the business. Remember, I mentioned this, right? Let Lidamalat Badasudha example. Easy to do compliance like that. You can say no to everything. Finish. I mean, my job is done. I say it's not done, so I say no. Then how is the business going to improve? How is your balance sheet going to grow? How is that you are going to reach your customers with newer, innovative products? You can't do that. So you have to play a supportive role. You have to tell them how to do. So therefore, you need to understand the business also. But remember, you are not party to business. You're only supporting, assisting, and guiding them to do the business the right way. Did you get this point clear up to this? Students, this is a very difficult thing to put into practice, but I tried my level best to make you understand it. Have you understood it?
Yes, sir.
Right. Just go back and think the way that you carry out your compliance function. Is it the way that we are discussing here, or is it different? Or there are improvements to be made? Right? I know some of you all can't answer, but answer is within you. Certain changes need to take place. Some of them may be structural changes. Some of them may be in the format. Some of them may be that, you alone can't do it. But that understanding is important for you to get to that place, get to that position. Then only it becomes a collective effort. Then only you can buy them in. That compliance, creating of the compliance culture, creating of that risk culture within the organization, creating of that audit culture within the organization, and make a learning culture in the organization. All these things will help. Ultimately, it will lead to good governance, where there's clear-cut policies, everything documented, transparency, disclosures coming very well to the point on the spot. You have perfect MI, where the decisions can be made very clearly, and specific decisions, very fast decision making can be done. And segregation of duties, no conflict of interest. All these things are connected. Right? So now you understand the importance of compliance, importance of governance, importance of making this understood by the others in the organization. That's the way forward. That's not an easy task, but if you really plan it out, and also your constant monitoring constant monitoring, training. All these are part and parcel of the compliance. I'm just repeating, saying these things. This is the type of approach and the quality of the answers that I am expecting when you are questioned or given the question paper. Right? So it has to be a very robust, comprehensive, the real practicing approach needs to be displayed in your discharging of your duties and answering your questions in the examination. Right. Now we are going to look at the audit contribution to governance. Right. And thereafter we will look at the risk contribution to governance. I know you have done this, the risk part of it, under a different module. You have done the risk part, no? Students? Have you all learned the risk function? In this is the program I saw, it was there in this thing. You have done it, right? No answer. Are you all with me or not? Is there anybody to answer, please? You have learnt in detail the risk part, no? How to do a kind of the risk approach to in the compliance function, or it may not have been in the same wording, but I'm sure I have seen in this material, the modules, right? There are certain I don't know who the lecturer was, certain modules which are devoted for that. So I guess and feel that you have some a good understanding and idea about how the risk function is involved in doing business in a compliant manner. Is that right? Or is it that you can't connect it? What have you learned about the risk?
We have learned about the risk-based approach in that CDD KYC that we have done.
Sorry?
The risk-based approach that on KYC CDD that we have done.
So is it only the risk-based approach on KYC? Anyway, so let's move on, right? So I'll give you that insight. So it's important for you to know this, right? Now, first we will discuss the audit contribution to governance, right? How important the audit function. When I say audit function, internal as well as the external audit function, to have good governance within your organization. The board should recognize and acknowledge the independent, competent, and qualified internal and external auditors, as well as other internal control functions, including the compliance function, are vital to the corporate governance process. Right. Now, the responsibilities of the board, again, it goes and lies and gets parked there. The board should recognize and acknowledge the importance of independent, competent, and qualified people are deployed into the internal and external audit function. The board needs to recognize it and acknowledge it. Right? Now, I think every bank, you have qualified people doing the audit function. The knowledgeable people carrying out that audit function. Right? So, now, again, you connect it. The board responsibility is to set the tone from the top. To look after the policy. To formulate the policy or approve the policy. So, as a policy, the board has to recognize the importance of having qualified expert people in the audit function who are entrusted with this task. It applies to external and internal auditors both, right? Plus the other control functions, including risk and compliance, other control functions. Those are the control. And if you take the 3 lines of defense, right? The conventional type of 3 lines of defense, who is in the first line of defense? Who is in the first line of defense?
The business.
Yes, business. Who is in the second line of defense?
Risk management.
Who else?
Compliance.
Yeah. Conventionally, type, they say business is one and there's no argument on it. Second line of defense, in general, it is treated as risk and compliance. The third line of defense is treated as internal audit. So this is the accepted norm. For your answering, you say. But my personal view, having hands-on to all 3 functions, risk, compliance, and audit, I would, if I am asked to give my opinion, I would put compliance in the third line of defense, not audit. That's my personal view. But when you change this, internationally accepted norms and concepts, you need to defend it, your argument or your concept, by way of doing a research and presenting a paper. So which I have not done, right? So therefore, my understanding, I'm saying, when you're answering, don't answer like that. You answer by, but I'm opening out your minds also. I have many reasons and justifications to say why I'm putting the internal audit, or rather the compliance, as the third line of defense, swapping that with audit, right? That's my personal view. But I have reasons to say, but I have to formally do it to establish that, to bring it as a theory or a concept. But it is definitely so important, the compliance function, that it functions as the watchdog, the main watchdog. The simple reason why I'm saying is, now the risk function is, they are taking, I'm opening it out to the risk also now. The risk function is taking input from, mainly from the, their observations, as well as from the internal external audit reports, and through the RCSA's risk control self-assessment, and by developing a risk library, and also by going through the management letter issued by the external auditor, and also by going through the regulatory inspection reports, supervisory concerns. So they are getting information from various sources and carrying out their risk analysis. They identify the risk. And of course, they have their various the risk identification tools and mechanisms. So they use all this to identify the risk. Then they measure the risk, they quantify the risk, then they assess the risk, then they bring risk mitigations and probably recommendations for mitigation of the risk, or to transfer the risk, or whatever it is. So that's the risk function. Then the internal audit, their main job is to make sure that the business is carried out keeping in line with the stipulated regulations and the provisions of the internal procedures. So in an audit report, technically you need to say it's a violation of this. They need to quote and say, yes. They are finding, they say, this has happened, this is done in contravention to the manual of operation, this section, this subsection, or whatever it is. Or they need to say this is a violation of that, whatever the circular. Of course, beyond that, the internal audit can also recommend the areas where the regulations are or the internal procedures are weak or don't present. That is also part of it. But why I'm putting the compliance in the third line of defense is the compliance role is such that they have to basically go through all the policies. All the policies, I repeat, and make sure the process owner has to do this. That's fine. Right? If you take the credit policy, the owner of the credit policy, it could be the risk officer or the credit head or whatever it is. So it can be a combination, joint ownership or whatever it is. So they have to bring it, but the compliance has to go through this. It's time consuming, can't help. It's their responsibility and make sure that the policy is comprehensive and robust enough to meet the regulatory requirements. Right? So meet the legal requirements. Meet the Basel requirements, which are regulations basically, or recommendations or intentional best practices. Or whether your credit policy and your provisioning is keeping in line with the what do you call this, the Institute of Chartered Accountants, LKS 39, accounting standards. That's your call. Right? Then the compliance need to make sure whether there are procedures within the organization in order to meet those so-called policy requirements. Right? Policy can be there, perfect policy, everything is fine. But there's nothing or little you can do if you don't have good, robust procedures, very well established within the organization, documented, established and put into practice in order to meet the policy requirement. That's also part of the compliance. That's what probably you will do in your compliance checks. You will select important policies and then get it into your compliance program for the year to make sure. If those procedures are adequate, yes, you say it's fine. If they are not adequate or weak, then you say, okay, there's a gap here. You are looking at from a holistical point of view and having a hawk eye, having an aerial view or a helicopter view, right? That's what I say, that there will be no second to anybody else in terms of making your governance in place, ensuring that your business is run in a compliant manner. Got it? Right. So, the internal audit, the board and the senior management should also recognize the importance and effectiveness of these functions to the long-term soundness of the bank. So, the audit contribution, the management and the corporate management and the board needs to recognize and give that recognition and understanding and acknowledge it. The importance of those audit function, or rather importance of having an effective audit function, which would ensure the long-term stability and the soundness of the bank. Right? That tone from the top has to be there. Then the board and the senior management can enhance the ability of the internal audit function to identify problems with the bank's risk management and the internal control systems by encouraging internal auditors to adhere to the national and international professional standards such as those established by the Institute of Internal Auditors, promoting the independence of the internal auditor, for example, by ensuring that the internal audit report has direct access to the board and the board audit committee. What does this say? The board and senior manager can enhance the ability of the internal audit function to identify problems with the bank risk management. And so audit needs to carry out the audit function in order to identify the problems or faced or encountered by the bank and the problems highlighted by the risk division. Which are very important. How can they do? By encouraging the auditors to adhere to the national and international professional standards. Then you have, when you are doing internal audit, you have the international standards, IIA, Institute of Internal Auditors, the world body. They are setting the framework of the audit function. So you need to be guided by the IIA principles, international principles. And those principles are looked at and moderated by the Institute of Chartered Accountants. Based on it, they bring the customized, audit standards for the Sri Lankan internal auditors and the external auditors as well. Right? So you need to encourage the internal auditors to adhere to the national and international professional standards which are established by the Institute of Internal Auditors, local as well as international, IIA, the International Internal Auditors Association. Then also promoting the independence of the internal auditor, for example, by ensuring the internal audit reports or has the direct access. So audit reports are presented. Technically speaking, the internal audit report is addressed to the chairman audit committee. Others are the side-by-side recipients. The report is addressed to the audit committee chair. And he's the main person to whom it's addressed. Why? Because it's an independent report and it needs to be brought to the notice of the audit committee chairman, who is a board subcommittee, regulatory subcommittee, compulsion to have. Then the board audit committee will go through and probably the cream and the essence of it will be highlighted to the main board for their information. Right? Then recognizing the importance of the audit and the internal control processes and communicating their importance throughout the bank. Now, internal control, that plays a very vital role. Every year, the internal audit needs to submit a report. We call it the ICOFR, Internal Controls on Financial Reporting. Right? So that's one of the main functions of the internal auditor to be done on an annual basis. Before the financials are reported or rather disclosed and presented, he has to carry out an investigation or exercise. You call it the ICOFR, Internal Controls on Financial Reporting. Identifying and assessing the internal controls that impacts the financial reporting and give an assurance to the board that these internal controls are well established, well in place and robust enough, and they have been duly put into practice. That comfort or rather report has to go to the board. It's an annual, very important exercise to be carried out by the internal auditors. And with that, they tell the board, we have assessed this, all the internal controls that leads toward the financial reporting, and they are okay in proper condition. Is the comprehensiveness is good enough, robustness is good enough, effectiveness is good enough, and it is actually being practiced. If not, they need to say, there's a problem here. There is a shortfall here. There's a weakness here. Either the control is there, it's not being implemented, which is material for audit report. But in this exercise, they are mainly looking at the comprehensiveness of the internal control. If the control is good enough, if the control is there, number one. If it is there, is it comprehensive or robust enough? 3, whether it is being duly implemented or can be implemented. If not, what are the hindrances or the pitfalls or the reasons why it cannot be implemented? Now, this is important in terms of the internal audit function. Right. So you are giving that. So with that, the board needs to actually, if I remember right, it comes the board has to give that certification before your accounts are finalized that they are happy about the effectiveness of the internal controls that are governing the financial reporting. Right? So they need to give that comfort to the main board. Or rather, it goes in the under the signature of the main board saying, okay, they're happy and satisfied with this. Now they're taking the responsibility. Because it's a governance principle where the board satisfy themselves as to the effectiveness of the internal controls on the financial reporting. Are they adequate enough? Right? And also prior to the audit function, prior to the financial reporting, any changes to the accounting policies that needs to be approved by the board audit committee before the financials are prepared and presented. Any changes? Example, any changes to the depreciation policy, accounting principle. Now, certain assets is depreciated on a linear method over a period of 3 years. That's the accounting concept approved by the board. And all of a sudden, if they are coming and saying, no, this year we expanded it to 4 years, thereby probably you are putting the depreciation down and it will impact the P&L. All those needs to go before the board before those changes are effected. So these are all the audit functions. Right? So that type of importance is given to the internal audit function and the internal control processes in order to have good governance, mainly in the reporting and the disclosures. Then utilizing in a timely and effective manner the findings, internal audits, and the requiring the timely correction of identified problems by the senior manager. Now, when the audit reports are presented, it captures various shortcomings, various deficiencies, and various issues, operational problems are highlighted in the audit report. When this happens, the board needs to give that definite the focus and attention on it in order to make sure that there are processes underneath at the operational level towards the corrective action. Otherwise, it's just going to be just a reporting, even compliance. For any report, I mean, it's not a matter of just reporting. It's a matter of reporting coupled with recommendations to overcome the issue. And then to be followed with the actual action, corrective action to get that issue sorted. So similarly here, when the audit reports are presented, you need to ensure that there's timely correction is done. And the senior management attention needs to be focused on it. Correction is done in a timely manner. Then they engage in the internal auditors to judge the effectiveness of the risk management and the compliance function, including the quality of risk reporting and the board and the senior management, as well as effectiveness of other key control functions. Now, the internal audit needs to carry out their process audits covering all the critical departments and the processes and the business verticals in the bank. When they prepare the audit program, like the compliance, prepare the compliance program, internal audit needs to prepare their audit program for the year. And that needs to be presented to the board audit committee and then to the board and get their approval for that. Similarly, like we had the planned activity, they also have planned activity. So they need to meet the audit program for the year. And there are certain regulatory requirements where every year they need to audit those departments. Example, they need to audit the compliance department. They need to audit the risk department. They need to audit the finance department. They need to audit the treasury department. Every year, process audit needs to be carried out. Right? In addition to that, the audit charter will tell how they are selecting branches and departments for the audit function of the year. That has to have a proper mechanism. How will you take things? Right? Example, you will say, okay, the branches that contribute to, I'm just giving an example, to say 20% of the, or rather 50% of your deposits will be just an example. So, but all this needs to be documented and kept. You can't just, decide, no, this month we do this, the other month we will do that. No, that is not a proper audit. You have to have a proper audit program. So here we are talking about how internal audit impacts the good governance. All this is part and parcel of it. So the audit policy will tell you the methodology in using identification of business units or the branches for the annual audit. One is as per the regulatory requirements, so internal processes, the head office department, regulatory requirements, the department I mentioned, compliance, risk, treasury, finance, all those needs to be audited. When it comes to branches, high risk branches, the branches which has thrown out a high risk rating. Just an example, each bank can have its own policy, but other than the regulatory one, good one is, better way is that all high risk branches will be audited every year until the risk status changes. Irrespective of the risk rating, maybe the branches which contributes large amount to your deposit base will be audited. Sometimes they are overlapping. You identify a branch, it's high risk, anyway it's there. But you go on this criteria also, sometimes you find, okay, this branch contributes 5% to your total deposit base. So that will come in, right? So you identify the branches which contribute 20% or 30%, whatever it is. X percentage to your deposit base will be audited. The branches that contribute Y percentage in total to your loan book will also be audited. Now that's how you identify. That is there in the policy. So you need to know as compliance, okay, they will not tell what and what branches for very obvious reason. Internal audit is done on a confidential basis. At least you can see whether, inquire and ask whether, how do you select your sample? What is the basis? Do you have a documented procedure? Whether it's approved by the board. That is how the board gets connected. The board function is the supervisory function. They are not doing the executive function. In doing the supervisory function, they need to have these things well documented and casting the responsibility on somebody to do that for them. Got it? So they engage in internal audit to judge the effectiveness of the risk management. So internal audit, likewise, I was touching on this, you need to get the internal audit to come and audit the compliance department. Very important, because compliance is playing a very vital role. If they fail it, I mean, there won't be anybody to come and say that, okay, you have not done this. It's like sitting on a volcano, right? Nobody is going to come and tell unless it erupts and making it total funeral all over. So you have to get them to do that. You have to get the audit to go and audit the risk department to say whether the risk department is doing their job properly. Because these are the watchdogs, defense lines, right? And including other strategically important and the operationally business-wise important departments and branches to be audited to see whether they are doing their job properly. Otherwise, say such a big branch, we are contributing huge amount of deposits to the your deposit base collapses for whatever the operational issues. And there's a major fraud taking place there, and the customers start looking how we are connecting all this. Then it's going to be utter chaos. So that's what I say, the surprises needs to be avoided every now and then. You need to do your business and formulate your strategies or the business operations, your controlling mechanisms, the risk audit and the compliance functions well knitted together and having a holistic view and approach to it is very important. So those departments need to be covered, as well as the effectiveness of other key control functions. How the control functions working? Are we sticking to our basic dual controls? Are we sticking to our basic ITGC, IT general controls? We need to, I will touch on it if I get time, if I can talk about the risk function a little bit. IT general control, extremely important, the basic test there, right? So this is the way that you can get the contribution to the audit function. So I think the time is up. So we have to stop it at this point for this week. I'm happy to answer any queries if you have in on the area that we discussed.
So there's one question, like then in audit department, when they audit compliance and the risk, in what areas, like in what basis they have to do the audit?
So, sorry, I didn't get your question right.
When you're auditing the compliance and risk departments.
Who is this? Uma, is it?
Susil.
Who?
Susil.
Susil, you are breaking up, Susil. I don't hear you well. Can you repeat it?
When you're auditing risk and compliance departments,
yeah.
In what base, in what areas we have to audit in those those departments?
So you are from audit, is it?
No, not audit. I'm from international. So then
right.
I just asking.
Okay, right. Now that you have to decide on a risk-based approach based on your resources, based on your, the time allocation, right? The mainly, if I'm there to do this in a compliance department, you would go and check whether they are doing their basic function. What is the basic function? You need to make sure that now how is this the system works? Policies are there, whether the policies are approved by the bank or the board. That is how the compliance function works, no? Approved by the board, then you have to do a secondary check to see whether the approved policy is robust enough. Does it cover all the regulatory requirements? Is it a holistically comprehensive one, or is it just a document? If there's problem in that document, everything fails down the line. It's like, putting up a building without having a sound foundation, right? And whether we have looked into the gaps. Have you done the gap analysis? Whether you have your, the important compliance functions that we discussed in the module 1 by the role of compliance, all that needs to be captured into the audit. I think your question was to ask what are the things that the internal audit would come and check in compliance department, no? That was your question, no?
Yes, sir.
So basically you need to check it in such a way that you are ensuring that the basic and the fundamental things are being done, failure of which will expose the bank to various risks because you are not checking on those. Right? So the comprehensiveness of that will depend on the audit officer's knowledge on the compliance function. When you are doing audit, you need to have an audit program. Right? Okay. Then that will tell in the department what are the areas you are going to check, and then the audit checklist. Before you issue the letter of engagement and the telling, okay, we are coming to do this, right? You need to identify what are the areas you are going to check there. And you deploy your resources accordingly. Right? So the key areas, like what I mentioned, needs to be captured into it if it's going to be a full comprehensive audit. Or if it can be a sample check method, anyway, the sample audit or a spot audit where you just take a few things here and there, and different audit methodologies are there, right? So instead doing a one comprehensive audit, you might do a couple of spot audits, right? If the resources are limited, sometimes you might do a full audit every 2 years. Now, certain departments you have to do annually because it's a requirement. So there are no compromise. In that case, it has to be a full audit covering the entire period. If that's not the case, depending on you put them onto the risk matrix. That's what I say, the audit methodology has to be there. It's all documented. That tells how to select branches and departments in your audit for the audit program. Right? So these are all connected. So then that basis only you come and see what and what things are happening. Basically, the key functions need to be looked at. Right? Have I answered your question now?
Yes, sir. Yes. Okay.
I'm from group number 8.
Okay.
My question regarding that our topic, regulatory structure and powers of the regulator. So now when we talk about this topic, we just only need to talk about the central banks or other regulatory authorities as well.
I think I included very consciously included the international perspective. Am I right?
Yes. Yes.
So you look at the regulatory structure. How this regulatory structure is stemming, right? Now the Sri Lankan regulatory structure also is definitely is based on that, following the international regulation. Okay. So you look at how this regulatory structure is stemming from, based on what, right? Then what are basically the laws and regulations, So basically you need to link between the law and the regulation, then, what type of, that you have to do a little bit of research, right? How these regulations came. It is, is it by way of certain laws that are passed, so the regulations are established. Understand?
Yes.
Now, for instance, now you take the MLCFT, there are certain laws passed, right? Based on it, the regulation came into effect, right?
Okay.
So your topic is, if I remember right, regulatory structure and the powers of the regulator, no?
Yes.
Why these powers are given to them, right? Then so you will probably understand the relationship between the civil law, the criminal law, and the different type of admin laws. Okay, so it's a bit of a thing that you have to more holistically look at it. What are the the different regulatory structural models, right? Then regulations by various objectives, by function, right? So that type of things. is fairly a broad one, and you need to do a little bit of reading to do this assignment. Basically, definitely you have to browse the net and get information on this.
All right, sir. Thank you very much.
Yeah, have I given you a flavor of it?
Yeah, of course, sir.
Right. So if you want, you may consult me again. It's a bit of a area where you need to definitely to do a little bit of browsing, huh?
Of course, sir. Sure.
And you can get. I'm just giving you a clue because that topic is a bit alien.
Yeah.
You can take the Sri Lankan regulatory powers and get some idea from that, and then you can do a kind of a, that we call it the reverse engineering. So
Yeah.
don't bring the Sri Lankan structure ready-made here. That's not what I want.
Yeah.
Right?
Yeah.
So you can take that and see where does it stem from. With that you can do. So you have to get involved in it. There's a lot of homework you need to do on this.
Sure. Okay. Thank you, sir.
Right? Who are the
Okay.
members in your group?
About 9 members are there, boss.
Yeah.
Um,
You are from which bank and which department?
I'm from MCB Bank and Compliance
MCB.
Department. Yes, Muslim Commercial.
Muslim Commercial, right. So I think so since you are a foreign bank,
Yeah.
you can get more insights to your, the parent bank, and, those things also can be taken into account. Who are the other members in this group?
They are from HSBC in.
Then good. I think probably I looked at those in giving this topic. So I know that, that was purposely, I think, given to you. That's why I asked which banks are you represented. So you can get more kind of, have more access to this type of information through your parent banks and things like that. All right?
Okay, we will, sure. Okay.
Yeah. If you are hitting a wall, you can consult me. Yeah?
Oh, sure. Okay. Thank you.
Welcome. Any other questions? And Lakshi, that I think you have to start now. There's a little bit of more reading you all have to do. Huh?
Okay.
It applies to others also. Any others? I'm once again repeating, if you all very seriously do your assignment, that will give you enormous knowledge. Once these are all circulated and it's shared with the rest of you will have, good 10 areas where with lots of knowledge you can use for your day-to-day functions, do your compliance function more effectively. So take it seriously and do. You are earning 30 marks out of this, the questions coming on this, plus the knowledge. It's enormous. That much I can vouch and tell you. All your presentations and whatever the findings are going to be circulated, and everybody will have access to it end of the day. And be party to this session when it's being presented. So you are going to learn a lot. So take this thing seriously. Yeah. Any other questions? No? Can we wind up? Okay. So we'll wind up for the day, and we'll meet up next week on Sunday. Right. Okay. Good day to all.